Do you know the code to realtor success? That's what we teach in here, the realtor code. Hi, I'm Mark McInerney, President and CEO of CodeMark Financial. Welcome to Mortgage Money Genius. In here, we teach realtors just like you all of the ins and outs of the most important part of the transaction, the mortgage game. Today, we're going to talk about non-QM loans, investment loans. Sit back, relax. 3, 2, 1. Off we go.
I just wanna be your superstar, 'cause it's not where you've gone, it's where you are.
All right, my friend. Well, I greatly appreciate you going on this journey and learning all of the different details inside of mortgages, from pre-qualified, pre-approved, talking about qualified mortgages. What is that? You know, but the traditional mortgages, right? Conventional, FHA, USDA, VA, jumbo loans. And we've already started opening the conversation around non-QM loans. And that is non-qualified mortgages, just meaning they just don't fit inside the box, which is good because everything inside of real estate nowadays is kind of outside the box, and you're an outside the box real estate agent. So let's continue to arm you with outside the box loan programs. So what we were talking about in the last couple episodes in non-QM is we started off with stated income and then no and low doc loan programs. And what that's just specifically meant is, well, those days of when a self-employed buyer does not want to provide documentation could qualify for these loan programs, which is good because it just gives them another option, especially if they don't want to go the traditional route, which you know as well as I do is a little bit archaic still with the amount of paperwork that is required to qualify those buyers, okay? Today, we're going to talk about investment loans. You're going to find that most non-QM loans are going to be largely suited for investors in most cases. And investors, because they have so much already attached to them, they already got their job, plus all of the investment properties, or plus whatever investment-related assets, they don't want to provide all the documentation for that just to get another loan. They're in this for money. It's more of a financial transaction for them than it is an emotional transaction. And it's worth considering, my friend. Building your business around working with investors could actually eliminate a lot of the headaches that is just associated with the real estate transaction. Not to say that home buyers that are first-time home buyers or second-time home buyers or buying that beach house or lake house you shouldn't work with, but again, it's just different. It's different in the sense that those have emotion attached to them because it's still familial. Whereas an investor is like, I'm picking that one up, and that one up for passive income, buy and hold, fix and flip, boom, here's that loan program. All right, Freddie, show them what that looks like. Let's just zip through here some of the bullet points and the strong features of non-QM loans. Number one, no income can be an option in terms of not having to show it, which is great because they don't have to provide the income when building out the loan application, okay? And if you'll notice, the name at the top of this says NONI, which is a non-owner, non-income or no income verified loan program. Sweet. The next part is no reserves. Okay, so here's just a quick note inside of traditional lending. When a buyer is looking to get a traditional loan, like a conventional loan, for the purpose of picking up an investment property, they have to end up having reserves for the houses that they already own on their credit profile. Well, what if they don't have that much? What if their liquidity is a little bit low because, again, they're spread out in all of their investments? It might make it difficult for them to qualify the traditional or QM route. Again, enter non-QM loan. Here, reserves aren't required. That's awesome. Number two is this kind of walks and talks the same like a conventional loan. Down payment is still 20%, which means financing up to an 80% LTV. Still haven't found anything lower than that. And rates as low as 5.75%. Now, look, you don't need to worry about interest rates. And quite frankly, I'll have you consider that your investor is not too particularly worried about interest rates either. They are well aware that even in the QM space, that an interest rate on an investment property is going to be higher than on a primary residence. They're well aware of that. They're already baking that into the investment portfolio aspect of the things. At 5.75%, starting at least at that price point or at that interest rate point, they're well aware that that is pretty darn aggressive for the flexibility that exists in this loan program and the lack of documentation that is needed. So, is there a little bit of a premium? Sure, but it's a premium to have the privilege and ease of making this a less headache-driven transaction. All right. Next one here as well. Credit score. Freddie, if you pull that up so they can see it, thank you. Credit scores in the mid 600s, so 640, 650 and higher. 1 to 4 family units. That means the single family, duplex, triplex, or fourplex. I have seen some whispers about even offering loan programs up to a 26 unit, which arguably is just a small apartment, which is awesome as well. Can also qualify on the property cash flow. Now again, if you're a little bit new to this and this is something that you're considering and offering to investors, what that means is maybe income-wise they cannot afford this house. They've got their job, they're maybe just break even on their current properties. It's kind of, a buy and hold long-term game. If they find a house that's already cash flowing, that cash flow could be counted as income already since already has the proof. This is very strong, and investors would understand that. And then the last part would be gift funds allowed. And what do I mean by that? Well, again, using that same example of a investor that might be depleted in liquid assets currently, maybe they've spread everything around, all of a sudden a real estate opportunity pops up, you look like a rock star saying, yo, look, check this one out, this is a killer. And he's like, man, I don't have the down payment. Call up good old mom. My mom's good like that. She knows that. Or good old business partner, or my man Freddie. My man Freddie is loaded with money. He's shaking his head back there. He's like, don't call me, don't call me. So gift funds, though, would be allowed, which is good because it also just still makes this a doable deal. All right, now let's get into the next stuff. Let's flip the script and talk about fix and flip. So inside of the fix and flip style loans, since HGTV has got everybody talking about flipping houses, let's look at this on some of the criteria there. You got that pulled up, Freddie? All right. Same thing. Credit scores, mid 600s, 640 plus, you're looking good, no problem. In this case, most fix and flip loans are going to be very specific to 1 to 4 unit family homes, okay? So again, a single family residence or a duplex, triplex, or fourplex, all right? It gets a little more complicated if it's going to be bigger than that, aka an apartment for fix and flip purposes. It could fall more inside of a commercial style loan. We'll talk about that in another episode. Same thing here, 20% down, up to an 80% LTV, but notice what I say here, 80% ARV, the after repair value. On the next slide, we'll show you what that looks like. And rates starting as low as 9.99%. Again, do not look at interest rates and think like, holy cow, are you kidding? I can't tell my clients it's going to cost them 10+%. When somebody is going to fix and flip a property, my friend, they're not holding on to this for hopefully no more than 6 months. I mean, the objective is to fix and flip the darn thing, all right? And in most cases, when the loan starts and the completion of the repairs are done and it goes listed, most investors are looking to do that within 6 months. But the good investors are, as I said earlier, baking those costs into the net proceeds that they're trying to clear. Now, if you're looking here, Freddie, if you show them the ARV calculation, here's a little knowledge for you, okay, so that you can understand what that looks like. And hold this up for a little bit, Freddie, while I explain to them. So the after repair calculation is simply this, and this is kind of the reverse science to it, right? So we're going to walk backwards on it. If the after repair value is a $300,000 house, this lender or these types of lenders are going to lend up to 80% of that, but that includes the rehab costs. So if you want to know how you would make an offer on the property, you would take the $300,000, that's the after repair value, that's what you would be listing it at, right? Multiply that by 80%. In this case, it gives us obviously $240,000. Now, again, I should say in this case, since let's just say we're talking about rehab costs of $50,000, you would back out the $50,000 from that $240,000, which leaves you a number of $190K. That, my friend, so that you're able to calculate this, is what you would be making the offer on that property for your investor. So that the investor goes and says, all right, I can get a loan, which you can tell them, up to 80%, including the rehab. What should we offer? There's the calculation on how to run that back. All right, that was a lot of information. I'm going to let Freddie go through some of those slides for you, and we'll be right back. You know what's cool? It's cool to be in the know. Because when you're in the know, you have certainty. I mean, think about when you're able to speak about things with absolute confidence. Now, you don't need to know all of the details of these things. Quite frankly, the guidelines are changing all the time. So are the programs. I'll even say that there's a lot of loan officers that don't know everything about these things all the time, because it's like the weather. They do sometimes change daily. But the idea is to have a general grasp of it, because by having a general grasp of it, you can have this conversation with these potential clients. And by having these conversations with these potential clients, you expand your business portfolio. And you know who are really good referral sources? You're right, investors. Because investors like to find one competent person that can get it all done all the time for all of their deals. What could that do for your annual commission growth inside of your business? We're going to talk about more. I like giving you guys the tools and that know-how. This is what Mortgage Money Genius is about. Do me a favor, would you? Like, comment, and share. Spread the word, right? There's plenty of business out there for us all. I'll see you in the next episode. I'm Mark McInerney, President and CEO of CodeMark Financial. Mortgage Money Genius. See ya.